Question number 24. So we have two excerpts here from the financial statements of Hassan and Co. for the year ended 31st December 2006. The first excerpt is from the statement of profit or loss account, and the second one is from the statement of financial position. The requirement here is to calculate the return on capital employed. To solve this question, we first need to recall as to what capital employed is and how is it calculated. So the capital employed are the funds that belong to the shareholders plus loans not repayable within 1 year, which essentially are the long-term liabilities. These are the funds that are invested on long-term basis to generate profits for the business. As the perspective here is long-term, short-term liabilities or those payable within 1 year are excluded from the definition of capital employed. There are two ways of calculating capital employed. Both the ways produce exactly the same results. It is just the matter of information available at your part that will decide which formula to use. Here is the first one. Capital employed is equal to shareholders' equity plus long-term liabilities. And the second one is total assets minus current liabilities. As I just told you that both the formulas will produce the exact same answer, it is just about the availability of information at your end in the question that will help you to determine which one to use. In the case of Hassan and Co., we don't have any information on any of the components of the second formula. Neither do we get to see the total assets, nor do we have the amount of current liabilities. So we will be using the first formula to calculate the amount of capital employed. As the information about equity and long-term liabilities is available in the question. The formula is capital employed is equal to equity plus long-term liabilities. The total amount of equity includes both the share capital of 20,000 and other components of equity of 15,600, which gives us a total of 35,600. Plus loan liability repayable in 2009. The amount of 6,900 is payable in 2009, which is after 3 years. It is a long-term liability. Let's add it to the amount of equity. This gives us an amount of 42,500 as the amount of capital employed. Next, let's revisit the formula of return on capital employed, or the ROCE as it is commonly referred to. The formula to calculate ROCE is profit before financing and income taxes divided by the amount of capital employed into 100%. Profit before financing and income taxes in our case is the amount of operating profit of 10,200. Let's put it into the formula. Next, divide it by the amount of capital employed that we worked out in the previous step, that is 42,500, and multiply it by 100%. And this gives us the answer, 24%. Let's put 24% into the answer bar at the bottom of the question.